A dollar earned in America does not belong entirely to the person who earned it. That much most people know. What most people do not know is that the same dollar can trigger multiple tax events over its lifetime. At the moment it is earned, again when it grows, and one final time when it is passed on. The government does not collect once. It collects at every transfer point along the chain. And if you do not understand where those transfer points are, you will spend your entire life working around the edges of a system you never actually mapped. This video is the map. We are going to follow a single dollar from the moment Marcus earns it, through every decision he makes with it, all the way to the moment his daughter inherits whatever is left. At each stop, we name the exact tax, state the exact rate, and show precisely how much survives. No rounding, no hype, just the math the tax code actually runs on. Let us start at the beginning. Marcus earns $1. Before it touches his bank account, 2 federal taxes arrive simultaneously. Income tax first. If Marcus sits in the 22% federal bracket, the government claims 22 cents on the taxable portion. But the first tax to actually reach into his dollar is payroll tax. The combined payroll tax rate is 15.3% on wages, split evenly between employee and employer. Marcus personally sees 7.65% withheld. His employer pays the other 7.65% directly to the government. Here is what most paycheck explanations skip. The Congressional Budget Office, in its analysis of the distributional effects of federal taxes, treats the full 15.3% as an economic burden on the worker, because the employer's share is compensation that would otherwise flow to Marcus but is rerouted before it ever reaches him. Legally, Marcus pays half. Economically, he absorbs both halves. We are following the economic dollar, because that is the dollar that actually built his life. On $1 of gross labor value, payroll tax claims 15.3 cents. Income tax at 22% then applies to the remaining 84.7 cents, taking roughly 18.6 cents more. Marcus keeps approximately 66 cents. That is federal only. In California, a 9.3% state bracket would cut further. In Texas, the state layer is 0. Marcus has 66 cents. He invests it. Stay with us here, because this is where the tax code reveals its actual architecture, and most people never see it clearly until it is too late to act on it. Marcus puts his 66 cents into a broad market index fund in a standard taxable brokerage account. Not a 401k, not a Roth IRA, a regular taxable account because he has already maxed out his tax advantage space. He holds it for 15 years. At a 7% average annualized nominal return, consistent with historical long-run U.S. equity market performance, his 66 cents grows to approximately $1.82 before tax. When Marcus sells, the IRS applies long-term capital gains tax. By this point in his career, 15 years of promotions and portfolio growth have pushed Marcus into a higher income tier. So to illustrate the full investment tax layer, we will use the top federal capital gains bracket. For a high-income single filer, that federal rate is 20%. But sitting beneath that is a second layer, the net investment income tax established under the Affordable Care Act, which adds 3.8% on net investment income above $200,000 for single filers. Combined federal rate 23.8%. His gain is $1.82 minus his 66-cent cost basis, which is $1.16. Tax at 23.8% on $1.16 is approximately 27.6 cents. Marcus keeps about $1.54. Now, here is something that permanently changes how you think about owning stocks in a corporation, and it almost never gets discussed this clearly. If Marcus bought shares in a C corporation, the profits that drove that stock's appreciation were already taxed at the corporate level before they ever lifted the share price. The federal corporate tax rate, fixed at 21% under the Tax Cuts and Jobs Act of 2017, applied to every dollar of profit that corporation earned before those earnings were retained. Those after-tax retained earnings are what drove the share appreciation Marcus is now being taxed on as capital gains. Legally, the corporation and Marcus are separate taxpayers, and a tax attorney will correctly point out these are different tax bases. But economically, both layers reduce the same underlying stream of business profits before any of it reaches Marcus's pocket. That is precisely why pass-through structures like S corporations, partnerships, and REITs exist. They eliminate the corporate layer entirely by passing income directly to the individual. The people using those structures are not cheating. They are reading the map. Marcus now has approximately $1.54. He decides not to spend it. He wants to pass it to his daughter, Priya. This is where the tax code does something that surprises almost everyone and that the wealthiest families in America have understood for generations. Here is the twist most people never see coming. When Priya inherits Marcus's portfolio, she receives a step up in cost basis. Under federal law, confirmed in IRS Publication 559, inherited assets receive a new cost basis equal to their fair market value on the date of death. Priya does not owe capital gains tax on growth that accumulated during Marcus's lifetime. If she sells immediately at the inherited value, her taxable gain is zero. Now, extend that logic further, and this is the part even financially literate viewers often miss. If Marcus had never sold his investments during his lifetime, he would never have paid capital gains tax at all. He could have held appreciating assets for decades, borrowed against them at low interest rates to fund his lifestyle, and at death, the entire embedded gain, potentially decades of compounded appreciation, would be permanently erased through the step-up. Under current law, that entire embedded gain may never face capital gains tax at all. A 2019 analysis by the Urban Brookings Tax Policy Center estimated the step-up in basis cost the federal government over $40 billion per year in foregone capital gains revenue. That $40 billion is not disappearing. It is transferring intact to heirs. There is still one more potential layer, the estate tax. If Marcus's total taxable estate exceeds the federal exemption, the amount above that threshold is taxed at a flat 40%. At the time this script was written, the elevated exemption established under the 2017 Tax Cuts and Jobs Act was in the process of sunsetting, with the exemption reverting toward an inflation-adjusted figure closer to $7 million per individual. For the overwhelming majority of Americans, the estate tax is not a real-world concern. But for families approaching that threshold, the exemption level and its legislative trajectory is not an abstraction. It is a planning deadline. For Marcus, whose estate sits well below either threshold, the estate tax does not apply. Priya inherits with a stepped-up basis and owes nothing on the lifetime appreciation. Here is the final accounting of the original dollar. $1 of gross labor value. Payroll and income taxes reduce it to 66 cents. Invested in a taxable account, it grows to $1.82 over 15 years. Capital gains, tax at 23.8% leaves approximately $1.54. Along the way, the corporate tax layers silently reduced the underlying profits before they ever translated into share price, an invisible layer embedded in the asset itself. At death, the step-up erases the remaining embedded gain. If the estate is below the exemption, no estate tax applies. 3 distinct tax events on 3 different legal theories, all triggered by activity that originated from a single dollar of human labor. Now, here is the mental model that changes everything. Most people think about taxes as a percentage of income. That is how they appear on every paycheck stub, every W-2, every tax software welcome screen. But that framing is the wrong lens entirely. The tax code does not follow income. It follows events. Every time money changes legal form, from labor income to capital asset, from realized gain to unrealized gain, from individual ownership to inherited asset, the tax treatment resets completely. The game is not about your tax rate. It is about how many taxable events your dollar passes through and at what rate each event is charged. The structural advantage is rarely about income. It is almost always about how that income is positioned after it is earned. That is why the Roth conversion ladder exists. Pay income tax once at a controlled rate, and the dollar never faces income or capital gains tax again. That is why the buy, borrow, die strategy works. Hold the appreciating asset, borrow against it so no taxable sale ever occurs, and let the step up eliminate the embedded gain at death. That is why wealthy families use irrevocable trusts, grantor retained annuity trusts, and charitable remainder trusts, not to avoid taxes illegally. To reduce the number of taxable transfer points the dollar must pass through. You do not need $10 million to apply this logic. Does your next investable dollar go into a taxable account or a tax-advantaged one? Does your appreciated position get sold, or can you borrow against it instead? Does your estate plan account for the step-up, or does your family reconstruct it later under pressure? These are not exotic questions for the ultra-wealthy. They are the basic coordinates on the map. Marcus spent his whole career thinking about his tax rate. Priya is going to think about transfer points. That shift from rate to structure is the difference between paying the maximum tax at every stage of life and paying the minimum at the stages that actually matter. The tax code does not follow malice, it follows events. Now you know where the events are.